What if I told you that while you were planning Christmas dinner, three of America's most powerful financial regulators coordinated an unprecedented strike against one of the oldest markets in human history? What if I could show you the precise timestamps, the mathematical mechanisms behind it, and the billion-dollar trap designed to halt a price move that could transform the entire precious metals landscape? And what if I could demonstrate that despite all their effort, the plan is already starting to unravel? In the early hours of December 24th, 2024, something remarkable unfolded in the silver market. Between 11:47 p.m. and 2:30 a.m., three separate regulatory announcements slammed into the market like synchronized missiles. The timing wasn't a coincidence. The approach wasn't improvised, and the consequences reach far beyond a simple move in silver prices. This is about control, about who gets to dictate how markets operate, and what happens when the physical truth of supply and demand crashes into the paper-based promises of the financial system. Let me walk you through what happened minute by minute, dollar by dollar. But more importantly, I'm going to explain why this coordinated regulatory intervention, despite its shock factor and mathematical precision, is likely to fail in ways the regulators didn't see coming. The first blow landed at exactly 11:47 p.m. Eastern Time on Tuesday, December 23rd. CME Group, which runs the world's largest derivatives marketplace, issued an emergency notice. Effective immediately, margin requirements for silver futures contracts were raised by 75%. If you're not familiar with futures trading, here's what that means in real-world terms. A margin requirement is basically a security deposit traders must keep in their account to hold a futures position. It exists to ensure traders can cover potential losses. Under the previous rules, holding one silver futures contract required $15 0 inches your trading account that was the minimum needed to keep the position open. Under the new emergency rule, the very same contract now requires $26.250. That's an additional $11.250 per contract. And this wasn't phased in over weeks or even days. It took effect immediately. As of 1 minute past midnight on Christmas Eve, if you didn't have that extra money available, you risked automatic liquidation. Just think about that timing for a second. This announcement hit late Tuesday night right before Christmas Eve, when most banks would be closed or running limited hours on Wednesday. Even if you had the funds sitting elsewhere, wiring large amounts on Christmas Eve morning would be close to impossible for most traders. The logistics alone create a forced liquidation setup, but the regulators weren't finished at 1:15 a.m. Just 90 minutes after the first announcement, the Commodity Futures Trading Commission, known as the CFTC, released its own emergency measure. They rolled out new position limits on silver contracts. Under the updated rules, no single entity is allowed to hold more than 5,000 silver futures contracts. That might sound like a huge number, and for most retail traders it is, but for hedge funds, commodity trading advisors, and other large institutional players, it's a tight constraint. If you were sitting on 6,000 contracts, you suddenly had 48 hours to cut your exposure by 1,000 contracts, or the exchange would liquidate the excess for you at whatever price the market was offering. If you're following this and trying to understand how these market mechanics really work, make sure you hit subscribe. We'll be tracking this story as it develops over the coming weeks, and you won't want to miss what happens next. The third strike landed at 2:30 a.m., completing the overnight trilogy of regulatory actions. The COMEX, North America's primary exchange for silver futures trading, issued a statement citing extreme volatility as justification for potential trading halts. The wording was careful, but the signal was obvious they were keeping the option open to implement what traders call a liquidation-only session. In plain terms, if prices kept ripping higher, they could shut off buying entirely. You'd only be able to sell, not buy. It's a nuclear-level tool that exchanges almost never use. But the fact that they publicly said they might consider it sent a loud message to the market. So let's pause and look at what this actually adds up to. Three regulatory bodies, the CME Group, the CFTC, and COMEX, released coordinated announcements. Within a 3.5-hour window in the middle of the night right before Christmas Eve. These organizations don't usually drop midnight notices on major holidays unless something serious is unfolding. The coordination suggests preparation, the timing suggests intent, and the mathematical impact, which we'll break down in detail, points to a very specific objective. Before we go further into the math and the strategy, I want to be completely clear with you. Here's an important disclaimer. Nothing in this video is financial advice. I'm not a licensed financial advisor, and I'm not telling you to buy, sell, or hold any investment. The silver market is extremely volatile and involves real risk. Futures trading in particular can produce losses that exceed your initial investment. You should always speak with a qualified financial professional before making any investment decisions. This video is for educational and informational purposes only, offering analysis of recent market events and regulatory actions. Always do your own research and understand the risks before you participate in any market. With that out of the way, let's continue, because the math behind what happened here reveals a carefully engineered trap. Imagine you're running a commodity-focused hedge fund. On Monday morning, December 22nd, silver was trading around $68 per ounce. Your analysis pointed to silver being undervalued based on supply dynamics, industrial demand, and the direction of monetary policy. So you decided to go long. You bought 3,000 futures contracts. With Monday's margin requirement at $15,000 per contract, you needed $45 million posted with your broker. Your fund had $50 million in liquid capital available, so you were comfortably funded with a $5 million cushion. Silver surged on Tuesday, closing around $74.50. Your position was suddenly worth a lot more. Those 3,000 contracts translated into an estimated $18 million gain in just 2 days. Your fund was up roughly 36% in 48 hours. Things were looking very, very good. Then at 11:47 p.m. Tuesday night, an urgent email hits your inbox from your broker. CME has issued an emergency margin hike. Your 3,000 contracts, which needed $45 million yesterday, now require $78.750000 starting at 1201 a.m. Wednesday. You have $50 million in cash. You're short $28.750000. The email says you must post the difference by 8:30 a.m. Wednesday morning or face automatic liquidation of your entire position. It's almost midnight on Christmas Eve. Banks are closed tomorrow for the holiday. Even if you had $28 million sitting in another account, there's no realistic way to wire that kind of money in 8.5 hours during a holiday window. Your choices are limited and none of them are good. Option 1, you try to plead with your broker for more time. But brokers have their own margin obligations with the clearinghouse. They can't extend you credit without risking their own regulatory standing. Request denied. Option 2, you liquidate roughly 1,000 contracts on Wednesday morning to free up margin. Every contract you sell reduces your margin requirement. But here's the catch. If everyone who got margin called is doing the same thing, all that selling pressure hits at once. The price drops hard. You're dumping into a falling market and locking in losses. Option 3, you do nothing and let the broker's automated systems liquidate all 3,000 contracts at whatever price the thin Christmas Eve market delivers. With liquidity reduced by the holiday, that fill could be far worse than current levels. This is what's known as a forced liquidation scenario. It has nothing to do with your fundamental thesis on silver's value. It has nothing to do with new information about supply or demand. It's purely the result of regulatory timing creating a sudden liquidity crunch. CME knows traders can't raise tens of millions of dollars overnight on Christmas Eve. They know it. That timing isn't an accident, it's the mechanism of the trap. Now think through what that forced selling does to the market. When New York opens on Wednesday morning, traders who got margin called start dumping positions. Silver, which closed Tuesday at $74.50, starts sliding. It drops to $73, then $72. That forced selling sets off stop-loss orders other traders had already placed. Those automated triggers add even more downward pressure. By mid-morning, silver could be trading near $68, even though nothing fundamentally changed in the real-world supply and demand for physical metal. Banks and institutions that were short silver, meaning they were positioned for prices to fall, can now cover those short positions at $68 instead of $74. They save hundreds of millions of dollars. That's the theory. That's what this regulatory playbook is built to achieve forced liquidation through margin hikes and timing push prices down, let shorts buy back at better levels, and reassert control over the market narrative. If this kind of breakdown is useful and you want to understand how markets actually work behind the headlines, consider hitting like and subscribing. These deep dives into market mechanics are what this channel focuses on. And when I first saw these overnight announcements, my immediate reaction was pure historical pattern recognition. This has happened before. In May 2011, silver hit $49 per ounce, the highest price since the early 1,980 seconds. The rally was incredible. And then CME raised margin requirements not once but 5 times in 9 days. The total increase was 84%. Silver collapsed from $49 to $33 within weeks. The rally died. The momentum evaporated. That 2011 margin hike strategy worked perfectly to stop silver's climb. So when I saw this overnight move, the first thought was obvious. Here we go again. They're rerunning the 2011 playbook. They're going to crush this rally the same way they crushed the last one. But then I started looking at today's market structure more closely, and I realized something critical. 2011 is not 2025. The market mechanics are fundamentally different in ways that make the same strategy far less likely to succeed. Back in 2011, the silver surge was driven mostly by leveraged paper speculation. Hedge funds were running 0 to 1 margin, sometimes even more. Smaller speculators were jumping into futures with maximum leverage. When margins rose, those highly leveraged players couldn't meet the extra deposits. They had no choice but to sell, unwind leverage, and the rally collapsed. It was a leverage-driven move that died the moment leverage was removed. But the 2025 rally rests on a completely different foundation. This move is being powered by 3 structural forces that are largely insulated from futures margin requirements. Let me break down each one, because these forces are the key to why this regulatory intervention is likely to fail. Force number 1 is the physical shortage. The silver market is currently running a supply deficit of approximately 1.1 billion ounces annually. That means global demand exceeds newly mined supply by more than 1 billion ounces every year. To put that in perspective, total annual mine production is roughly 800 million ounces, so demand is exceeding new supply by more than an entire year's worth of mining output. That shortfall is being covered by above-ground stocks, inventories, and recycling, but those sources are limited and shrinking. COMEX warehouse inventories, which represent the physical silver backing futures contracts, have fallen to roughly 24 million ounces. That sounds like a lot until you recognize that open interest in silver futures represents claims on far more metal than actually sits in the warehouses. The ratio of paper claims to physical metal has never been higher. And here's the key point: raising futures margin requirements does not produce physical silver. It doesn't open new mines. It doesn't accelerate refining. It doesn't move metal faster. The shortage is real, and regulatory tweaks to paper markets don't fix physical constraints. Force number 2 is industrial buying. This may be the single biggest reason 2025 looks nothing like 2011. Silver isn't just a monetary metal or a speculative instrument anymore. It has become essential to modern technology. Solar panels require meaningful amounts of silver. Each panel uses about 20 grams. With solar installations expanding worldwide, that translates into hundreds of millions of ounces of annual demand. Electric vehicles use silver across countless electronic components. 5. G infrastructure needs silver. Medical devices, water purification, and a long list of other applications create steady, non-discretionary industrial demand. Companies like Samsung, Tesla, and First Solar aren't trading futures for fun. They're buying physical metal with cash because they need it to keep production lines running. These industrial buyers have procurement managers whose job is to guarantee supply continuity. They operate with budgets in the hundreds of millions of dollars. They've been authorized to pay whatever it takes to secure material, often up to $85, even $90 per ounce. When CME raises margin requirements on futures contracts, Samsung's procurement manager in South Korea doesn't care. He isn't trading futures. He's buying physical bars from refiners and dealers. The margin hike is basically irrelevant to his purchasing decisions. His choices are driven by production needs, inventory thresholds, and delivery schedules. If anything, a temporary dip caused by forced liquidation in the futures market simply gives him a better chance to lock in supply at a discount. Force number 3 is what's known as a gamma squeeze in the options market. Force number 3 is what's known as a gamma squeeze in the options market. This is more technical, but it's critical for understanding the upside pressure. Market makers who sell call options on silver have to hedge their exposure. When they sell a call option, they're taking on the risk that price will rise. To hedge that risk, they buy futures contracts. How much they need to buy is determined by a mathematical process called delta hedging. Right now, there are approximately 4,7,000 call option contracts with strike prices between $67.50 and $75. Many of these are already in the money or sitting right on the edge of it. As silver rises, the delta on those options shifts, forcing market makers to buy more futures to stay properly hedged. That creates a self-reinforcing loop. Higher prices force more hedging creates more buying pushes prices higher, and that in turn forces even more hedging. The key point is that this hedging is automated. It's executed by computers following mathematical formulas. The algorithms don't care about holidays, margin changes, or dramatic regulatory headlines. When delta moves, the hedge gets executed. The buying happens whether it's Christmas Eve or an ordinary trading day. This mechanical demand is built into the market structure, and it isn't something regulators can simply switch off. Now let's talk about what happened when markets opened after these announcements. Banks and regulators were expecting forced liquidation and panic selling. The goal was to push silver from $74 down to $68 or even lower, trigger a crash, shake out weak hands, and regain control. In the overnight electronic session, there was real panic. Silver dropped hard to $70. That's a $4.50 move, about a 6% decline in just a few hours. Forced liquidations were happening exactly as designed. But then something interesting happened. The selling didn't keep cascading. Instead, buyers stepped in aggressively at $70. Price snapped back sharply to $72.10. As of this recording, it's trading around $71.78 with heavy back and forth volatility. And that price action tells us something important. Real buyers with actual capital and actual demand for silver, saw the overnight drop as an opportunity. They weren't intimidated by the regulatory announcements. They viewed the dip as a gift. That's fundamentally different from 2011 when margin hikes triggered sustained selling that pushed prices lower for weeks. Here's the real test that will tell us whether this intervention succeeded or failed. It's not what happens in New York on Christmas Eve. It's what happens when Asian markets open on Thursday morning, when traders in Shanghai, Hong Kong, and Tokyo wake up and see what happened in New York. What do? Do they panic and sell, or do they recognize the forced liquidation for what it was and treat it as a buying window? The signal to watch is the spread between COMEX paper prices and Asian physical premiums. If COMEX trades at $68 on Wednesday, but physical silver in Shanghai trades at $82 on Thursday morning, that $14 premium is shouting the truth. It's telling you the physical market didn't accept the paper market pressure. It's telling you the COMEX dump was artificial, driven by forced liquidation, not by any real shift in supply and demand. If Shanghai opens at $82 on Thursday morning while COMEX closed at $68 on Wednesday evening, that's your answer. The trap failed. The physical market is pulling away from the paper market. And once that split becomes obvious to everyone, the scramble to secure physical metal accelerates. Let me give you a roadmap for how I expect this to unfold over the next several days and weeks. Wednesday, December 24th, is defined by volatility. We've already seen the drop to $70 and the rebound to $72. The shakeout is happening right on schedule. Some weak hands and forced sellers are exiting, but the buying support is far stronger than regulators expected. Thursday, December 25th, markets are closed for Christmas. That pause gives everyone time to evaluate. Banks and regulators spend the day studying whether their strategy actually worked. Did they break the rally, or did they simply manufacture a temporary dip that will get bought aggressively? Friday, December 26th is the real test. That's when the market delivers its verdict. If silver opens Friday at $73 or higher, the message is clear: the Christmas intervention failed. The regulatory assault didn't break the rally. The runway to $75 is wide open. And once $75 breaks, the next wave of gamma hedging ignites. There are roughly 4 call option contracts sitting at the $75 strike. Once those go in, the money market makers have to buy futures to hedge. That's roughly 150 million ounces worth of hedging demand. But there's no way to source that much metal quickly. The inventories aren't there, so price can gap higher to $80. At $80, the cascade keeps going. More options move in the money. More hedging demand kicks in. We could see $85 by the end of the following week. We test $90 by early January. And $100 becomes not just possible, but increasingly inevitable, because the math is the math. The physical shortage is real. Industrial demand is real. The gamma squeeze is real. And regulatory announcements don't change any of those underlying forces. So what should you do right now if you're involved in silver markets? Let's walk through a few scenarios. If you own physical silver, meaning you hold actual coins or bars in your possession, or you have allocated storage with specific serial numbered metal, the answer is simple: do nothing. Margin hikes don't touch you. Position limits don't touch you. You own the metal. It's in your safe or your vault. The banks need it, and they can't take it from you unless you decide to sell. Physical holders have the ultimate advantage here. Hold your position. If you own silver futures contracts, you need to make a decision immediately. Can you meet the new margin requirements? If you can comfortably post the additional capital, then holding through the volatility could still make sense based on your analysis. But if you can't meet the margin call, you have to choose. Do you close the position voluntarily in the overnight session around $72, or do you risk forced liquidation during thin Christmas Eve trading, possibly at much worse prices? That's a personal decision, and it comes down to your capital, situation, and your tolerance for risk. If you hold paper silver products like certain ETFs, understand that trading halts and regulatory interventions increase the chance of cash settlement instead of physical delivery. Some products can pay you a cash equivalent rather than deliver actual metal. When physical supply is tight, that risk grows. You may want to research vehicles that hold allocated physical metal where you have stronger delivery rights. Or consider shifting toward physical ownership entirely while markets are still functioning normally. If you don't currently own any silver and you're thinking about entering a position, Wednesday morning could offer an opportunity. If forced liquidation pushes the price down to $68 on thin Christmas Eve volume, that might be your last chance to enter below $75 before the next leg higher begins. That said, timing short-term swings in a volatile market is extremely difficult. If you decide to enter, understand the risks and size your position appropriately. Before we wrap up, subscribe if you haven't already. We're going to track this situation closely over the coming weeks. The silver market is at a critical junction, and what happens next could matter even if you're not directly trading it. The forces we're seeing here, the tension between physical reality and paper markets, between supply constraints and regulatory intervention, show up in other markets too. Hit subscribe so you don't miss the follow-up analysis. What we're witnessing isn't just a market move. It's a conflict, a battle between two competing visions of how markets should function. On one side is the physical reality of supply and demand. Mines produce a certain amount of metal, industries consume it, inventories either rise or fall based on that balance. That's the real economy, the physical world. On the other side are the paper markets, futures, exchanges, derivatives, and the regulatory bodies that oversee them. These markets are supposed to reflect physical reality and provide price discovery and hedging. But when paper claims vastly outnumber physical metal, and when regulators can rewrite the rules overnight to favor certain participants, paper and physical begin to disconnect. In that scenario, the banks are losing the physical battle. They can't conjure silver out of thin air. They can't force mines to produce faster. They can't create inventories that don't exist. So they're trying to win the regulatory battle instead, using margin hikes, position limits, and holiday timing to manufacture a price drop and buy themselves time. But time is the one resource they don't have. Every day that passes, industrial buyers consume more silver. Every day, vault inventories drain a little further. Every day that refineries stay frozen or operate below capacity due to various constraints, the physical deficit widens. Regulators can create short-term volatility. They can shake out weak hands who are over-leveraged or who panic easily. They can engineer flash crashes during low-volume holiday sessions when fewer participants are trading. But they cannot manufacture silver. They can't fix the shortage. And they can't override the math of supply and demand. This overnight regulatory intervention might work for 24 hours. It might produce a frightening dip on Wednesday morning that tests traders' conviction. But by Friday, I expect prices to be higher than they were before the announcements. By next week, we're likely testing $75. And by January, the broader market will start recognizing that the traditional regulatory tools are losing effectiveness when they're applied to a market facing real physical constraints. Think about it from first principles. Somewhere right now, a grandmother in New Jersey owns 500 ounces of silver she bought in 1985. It's sitting in her safe deposit box at her local bank. She doesn't follow futures markets. She doesn't know what CME is. She has no idea what a margin requirement even means, and she isn't selling. Her silver isn't available to the market at any price because she sees it as long-term savings and insurance. At the same time in Seoul, South Korea, a procurement manager at Samsung is staring at inventory spreadsheets. He needs 4 million ounces of silver to keep production lines running through the first quarter of next year. He currently has 8 weeks of supply on hand. Management has authorized him to pay up to $85 per ounce to lock in supply because shutting down production lines would cost far more than paying a premium for silver. He doesn't care what COMEX regulations say. He doesn't care about margin requirements. He cares about securing physical metal before inventory runs out. So, who wins this contest? The grandmother holding physical metal and refusing to sell? The Samsung procurement manager who needs physical metal and has near unlimited budget authority? Or the banks that sold paper contracts promising to deliver metal they don't actually have? The answer becomes obvious when you frame it that way. The regulatory intervention we saw overnight is the financial system's last desperate attempt to maintain control over a market that's increasingly being driven by physical reality rather than paper trading. It may succeed in generating short-term volatility and shaking out some leveraged speculators, but it can't change the underlying supply and demand forces driving this market. Over the next few weeks, we're going to find out which force is stronger. Will regulatory intervention and paper market pressure succeed in capping prices and restoring the old order, or will physical shortage and industrial demand overpower the paper market's ability to hold prices down? Based on the structural factors we've discussed, my analysis points to the physical side winning this fight. But we'll track the data closely and let the market reveal the truth. The Christmas intervention was a coordinated strike meant to break the rally and reassert control. The margin hikes, the position limits, and the threatened trading halts were all designed to force maximum liquidation at the worst possible time. The timing right before a major holiday when liquidity is thin and traders can't easily raise capital was deliberate. But the plan appears to be slipping because the foundation of this rally is fundamentally different from earlier rallies that were successfully suppressed. Don't let short-term volatility shake you out of well-reasoned positions. The grandmother in New Jersey isn't selling because of a midnight regulatory announcement. Samsung isn't canceling purchase orders because COMEX raised margins. And if your thesis is built on physical shortage and industrial demand, not short-term price momentum, then your thesis hasn't changed. The conflict isn't over. If anything, it's escalating. As the physical shortage becomes harder to ignore as inventories keep declining, and as industrial demand stays strong, the pressure on the paper market intensifies. Eventually, something has to give. Either physical prices disconnect completely from paper prices, or paper prices are forced higher to reflect physical reality. Either outcome is significant. We're living through a fascinating moment in financial history. Traditional tools of market control are being tested against real, unavoidable physical constraints. The outcome will matter far beyond silver prices. It will tell us something important about how modern markets function, about the limits of regulatory power, and about what happens when financial engineering collides with physical reality. Stay informed, stay rational, understand the risks, and watch what happens next, because this story is far from over. This is only the opening chapter in what could become a much longer transformation in how precious metals markets operate. Make sure you're subscribed so you don't miss the developments. Thanks for watching, and I'll see you in the next video.